Man, you hear me bag on 401ks all the time, but do you actually understand why? Listen, a lot of people enroll in 401ks, they do it because everyone else is doing it. It's like a bunch of lemmings that are just going over the cliff. In today's video, I want you to understand what a 401k is, all of its different components, and understand why it's a ticking time bomb, because in the end, it's gonna screw you over, and you deserve to understand why.
One shot, not a future for sure. Let's go. I'm turning dreams into reality. Yeah, it's one shot, not a future for sure. Let's go.
So let's start by actually talking about what a 401k is. You make it through college and it's time for you to start your career, so you land that job and you're sitting down with HR and they say, guess what? Our company has this cool thing called a 401k match, and it's your ticket to a good retirement. So what is a 401k? A 401k plan is a company-sponsored retirement account that employees can contribute income to while employers may match contributions. With the traditional 401k, employee contributions are pre-tax, meaning they reduce taxable income, but withdrawals are taxed. Now, what that basically means is, hey, I'm going to contribute $10,000 a year into my 401k, and my company's going to match the first $6,000 of it. So here I go. This year I put $10,000 in, my employer put in $6,000. That's $16,000 that goes towards retirement. And the $10,000 that I put in, I didn't have to pay taxes on. So far it kind of sounds like tax-free money meets free money from your employer. Sounds like a pretty good gig, right? So there are some nuances to your 401k that you need to understand. And the first one is, when you put money into it, you're thinking, I need to be long-term committed to this, because until the age of 59 and a half, if I want to withdraw any of it, there's going to be automatically right up front a 10% penalty. I want you to think about that. If you had over, let's say, a decade put in $50,000 into your 401k, and now you wanted to take it out, the first expense is $5,000 gets flushed away. That's your penalty, because you were putting money in and you were supposed to wait till 59 and a half before that penalty could actually go away. Problem is that as you get older, you get wiser. And as you start setting money aside, you get to this point where you realize, wait a second, I'm not setting enough money aside for retirement. I can't save enough money, which means you start transitioning your mindset to an investor mindset. Looks like I need to actually take my money out and I need to put it in things where I can grow it more aggressively than the market, because a traditional 401k over 30 years is going to grow at an average rate of 5 or 6%. Now, just to help you understand, over 20 years, that means that account will triple. So if you had $50,000 into it, then after just 20 years, it could become $160,000. You start saying, wow, 20 years, that was half of my working life. I don't have a lot of time left. I don't have time for it to grow only at 5 or 6%. So you know what? I want to withdraw some of this money, and then I want to put it into a franchise, or I want to put it into real estate, or I want to put it into something that will actually make me some cash flow or give me better tax benefits. And that's when you get hit with this first shock. Shoot, if I want that money, there's a 10% penalty that I really didn't fully understand. The second disadvantage that you need to be aware of is that even if you're okay paying that 10% penalty, which if it's for a worthy endeavor, I call that a cost of business. That's the price you have to pay for getting it out. That's a consequence. But the second one is the government says, yo, remember that you didn't pay taxes on that while you're putting it in? Well, guess what? Now we need to tax you. And by the way, you're not putting in like $6,000 and $8,000 and $12,000. Now you're pulling out $100,000. Well, that bumps you into a higher tax bracket. What if you end up paying 20% taxes on that? Could be even more. Well, now that's $20,000 you've lost. And now guess what you're thinking? I lost 10% to penalty. I lost maybe 20 whatever percent to tax. That's like a third of my money gone. So the longer you're in that program, it's only a matter of time before you start experiencing the tax bomb. So let's talk about this tax-deferred time bomb. Today, the highest federal tax rate is 37%, but it has floated as high as 94% in 1944. There was also 3 decades in the 50s, the 60s, and 70s where the federal tax rate never dipped below 70%. Do you really want to roll the dice on what future tax rate you'll pay at retirement when today's rates are some of the lowest in the past 100 years? Well, all of that to simply say there might never be a cheaper time to roll it out than now. And while you're thinking, well, the penalty is a problem and paying the taxes is a problem, what you really have to calculate is what your opportunity cost is. Opportunity cost is an economic term for what are you foregoing, right? You're making a 401k choice hoping that it's going to be enough, and then you start doing the math and realizing, wait a second, what am I missing out on? That's what opportunity cost means. Did you know, according to Vanguard, in your 60s, that the average 401k balance is under $90,000? Now I want you to think about that for a second. Then you can add to that, well, what about my IRAs? My CPA said to put some money in an IRA, and I also got this little annuity and this, this other tax savings account thing going, and you start adding all that up, and by 65 years old, your average retirement is right around $200,000. And yet, in your mid-50s, you hit your peak earnings at right around $90,000. So think about this. Average American, by their mid-50s, is now making $90,000 a year, and yet you're going to get $200,000 at retirement. Sure, you're past 59 and a half, you don't have the 10% penalty, but guess what? If you want that money, you're going to be paying taxes on it, which really means you only have 2 years at most of income. Think about that, 2 years? Well, at some point you're going to do the math. At some point you're going to figure this out. I hope not too late, right? If you're young, get it now, because when you get too late, you'll have lost your most important asset, time. Let's just say that you're 55 years old and only a decade until retirement. And you're like, wait a second, I've lost 25 years. I only have 10 years left before retirement. What can be done? Pay your taxes, pay your penalties, and start investing the way you should have been in the beginning. All right, so let's take a look at the pros and cons of a 401k. We've explored both. Here's some of the advantages. Number 1, the money is tax deferred. And number 2, you've got an employer that may be doing a match, which means down the road there could be some quote unquote free money. And number 3, there's predictability in the consistent returns, although they're not very high. However, there are some cons, some disadvantages that you should be aware of. Number 1, you're only tapping single-digit ROIs. And I've already showed you earlier that that doesn't exponentially grow into a whole lot of money. In fact, compound interest only becomes powerful when you start earning double-digit returns, not single-digit. Number 2, you give up control of your money. In fact, it's not just control. There's fear-mongering that goes with this idea of, oh no, 10% penalty, oh no, pay my taxes, I should never take that money out. Meanwhile, you're screwed if you don't and you don't invest. And then finally, number 3, you have limited investment options. It's basically sitting in the market. Now, if you're watching this video and you do have a 401k, you might be wondering, geez, Kris, taxes and penalties, please, please, please tell me that there is a loophole. And you know what? There is. So one of the things that you should be aware of is that there are 2 types of 401ks. There's 401k money that you've earned from past employment that you have rolled over perhaps into a current 401k. In other words, let's say that 20 years ago you had spent a decade working for a company and you got $100,000 in your 401k, but then you left the job and got another job in the same industry, and you said, well, we'll take that 100k and we'll roll it into this other 401k. And over the last decade, I've earned another 100,000. Now my account balance has $200,000 in it. But not really. I want you to think about this. You actually have $100,000 from your previous employment and $100,000 from your current employment. Why should that matter? Because money with your current employer you can't touch, but money from your past employer, the rollover amount, you can touch that. What you can do is you can take it, you can move it into a self-directed 401k. So here comes $100,000 out, it goes into a self-directed account. You avoid the penalties, you avoid the taxes, and now that $100,000 has been pulled out of the stock market and you have limited investment options. There are ways, for example, of buying real estate with it. There are ways of using it for other investments. And all of a sudden, guess what? You have just taken advantage of a great loophole. But Kris, what if I have 401k money with my current employer? Well, there's a couple of things that you should be aware of. You could talk to HR and you could ask for an in-service distribution. There's a small chance they might allow you to take it out, in which case you could also self-direct it and avoid taxes or penalties. You also might be able to just liquidate it and pay taxes and penalties. And if you get in on some of the investing that I do, that's worthwhile all day long because the returns are so high. And the other option is to stop contributing to your 401k. But Kris, I'm gonna lose out on the free money. Are you? I would rather have less money in my bank account that I can control, that I can invest with. Like, you realize that most people will spend plus or minus 90% of the money that they make. It's called Parkinson's Law. And at the end of the day, that means that you likely don't have a lot of discretionary money left over for investing at the end of the day. Your 401k contribution might be your best access to setting it aside, doing what I did. Take $5,000 and over 4.5 years, turned it into $1.6 million, turned that into a $12,000 a month residual income through real estate, left my job, became financially free, and then from there, I doubled my portfolio every year and I kept on going. Now, there are some other reasons why you could technically be an exception to the 10% penalty rule. Here's actually a list of them on screen. You can receive payouts over time. You qualify for a hardship distribution with the plan from an administrator, like, hey, we've fallen on rough times, we don't have enough money to pay our bills. That might be an exemption. Perhaps you leave your job. Maybe you're over a certain age, you're getting divorced, you give birth to a child, or you adopt a child, you become disabled, you put the money in another retirement account, you use the money to pay an IRS levy, you use the money to pay certain medical expenses, you were a disaster victim, you are in the military, or you die, okay? So obviously there's some exceptions to look into, and for me, I say leave no stone unturned in exploring all of your options. So what then are some of the popular choices that people do with 401ks once they pull that money out or once they self-direct it? Well, there's two super popular options. The first one is invest in real estate, right? I mean, for me, I can earn always a minimum 25% ROI. That's the goal and focus. And when you compare that to what a 401k will give you, you can literally make 27 times more money over a 20-year period of time and literally become a multimillionaire. Another option is you could take that money out, and I see people put it into franchises, right? Franchises have a 91% success rate, but they have sometimes a $50,000, $60,000 or $100,000 startup rate, but they can produce enough money where you can be an absentee owner in many situations and literally have that be your new job that you're putting very little time in, but you've replaced and supplemented all your job income. If you're interested in learning more about real estate or franchises, click the links below. I've got one for each, and let me share with you what it would look like to either partner with me in the game of real estate, or let me point you in the direction of some of the most successful franchises out there, where a little bit potentially can go a very long way. Hey, thanks for joining me on today's video. Check it out. The internet thinks that the video you're gonna love the most is this one right here. Check it out, and I'll see you there. Screw you over, and you deserve to understand why.
I came on like your last word you put in.
Did you get it, you think?
I got it, but